I'm joined by Mitul Kotecha. He is Global Head of Forex Strategy at Credit Agricole here in Hong Kong. So good to see you. Thanks for coming in. So these stress tests, we're going to get the results on the 23rd of July. Long awaited. We've been talking about this for a long time now. What do you expect?
Well, I think we've had a lot of leaks, a lot of rumors. It's very likely that the majority of banks will pass the test reasonably well without significant funding requirements. The big issue and the big question is that could prevent this from being a buy on rumor, sell on fact, is how rigorous the stress tests are. What sort of haircut on sovereign debt exposures do they involve? What sort of global or growth scenarios for Europe do they involve? How much balance sheet deterioration? A lot of unanswered questions that still need to be revealed before we can really pass judgment on these stress tests.
But we do know a little bit, don't we, about the nature of the tests, and the overall conclusion seems to be that they're not going to be rigorous enough, that perhaps they wouldn't have even proposed these tests if they didn't think the banks were going to pass.
I think that's probably right. I mean, for instance, it was Spain that had pushed these stress tests forward very aggressively, and of course that pushed the rest of the European Union into doing it. And we know that a lot of attention has been on Spanish banks. So the fact that Spain is doing this suggests that actually their banks are going to do reasonably well. We've had a lot of government officials saying, well, our banks are going to do well in the stress test. So as you say, markets may have the right to be a bit sceptical about the results when they do come out on Friday, especially if they're seen to be less rigorous. And I think that could result in a bit of a negative bias for European markets and potentially the euro.
Well, we shall have to wait and see. A few days here yet to go. Now, you mentioned Spain there, so I want to switch gears and talk about the euro, because the euro is a lot higher than it was just last month. It's at around 128, 129, and we had the head of Spain's Exporters Club today saying that stronger euro could make it harder to counter a paralyzed domestic market. So he's concerned about Spanish exporters. Could we see a high euro actually snuffing out the recovery in Europe?
Well, it's very probable. The problem is that a lot of, certainly including our forecast for European growth, one reason why we're not expecting a double dip in the European economy next year is principally because the euro is going to be weaker, and we forecast Europe to be weaker. Now, of course, if the euro continues to strengthen, that could be very, very negative, especially when you consider that the export engines in Europe are these high-growth economies such as Germany, Austria, Netherlands, etc. And if exports and the euro continues to remain this strong, it's a big disadvantage for Europe.
These guys are hoping that a boost in exports created by the euro is actually going to help them ride this out. We had EADS this morning saying that 120 isn't even weak. They don't consider that weak. Where are you forecasting the euro?
Well, actually, our year-end forecast is 112, so it's quite an aggressive decline from current levels. Obviously, it's now pretty far from where we are, but we still hold the view that the euro should weaken. I think we're now approaching the limits of euro strength. I would tend to agree that around 120, 118, 115, 120 is a more realistic level for the euro in the medium term. It's where we would see fair value. At current levels, the euro is clearly overvalued, unlike other currencies such as sterling, which are undervalued. So I think there's going to be more downside.
Interesting that you talk about fair value, because Bloomberg's been compiling some purchasing power data, and the survey suggests that the euro is 14% overvalued. Would you go that far?
I would tend to agree. I think the euro is definitely significantly overvalued, and I think we'd put, if you look at purchasing power parity, for instance, that's about 118. Our own fair value measures suggest around 120, 123 as fair value. So whichever way you look at it, the euro is pretty overvalued and getting more overvalued by the day.
Now, how do you explain this euro strength, especially given the state that the economies are in? I mean, some people have been saying the recent run-up in the euro is really not about the euro at all. It's about dollar weakness.
Partly, I think it has reflected dollar weakness. We've had double-dip concerns in the U.S. economy to undermine the cyclical story for the U.S. dollar. But at the same time, we know the market was extremely short euro, so we've seen a big short covering take place. Part of that is, it's a big squeeze, and part of that is because of the fact that I guess we've had this 750 billion euro fund. Some of the sovereign concerns have eased. We've had some reasonably good debt auctions across Europe. So some of the worst fears have gone now. But I think a lot of this news is priced in, and that's why I think we could end up with this buy on rumour, sell on fact on Friday.
Yeah, we may end up with a bit of a shock, perhaps, on Friday.
Exactly.
Certainly a reassessment of conditions then.
I think so.
Okay, Mitul Kotecha from Credit Agricole, thank you very much for joining us.